The U.S. housing market is currently in a transformative phase. On one hand, middle-class America cannot afford homes. And on the other side, even those who can afford homes are looking for what they can get for their house, and the price tag, frankly, is not that pleasing. Now, as it undergoes these significant shifts, the Federal Reserve's reaction and strategies become pivotal for homeowners, potential buyers, and investors. Now, in this video, we will dive deeper into the intricate dynamics at play and offer some insights into what the future might hold for the Federal Reserve and the housing market. But right before we jump in, guys, please hit that like button, and to stay updated, make sure to click that subscribe. So, for many Americans, the escalating mortgage rates are a source of anxiety, and these increasing rates are steadily eroding the affordability of homes. The recent surge of 10-year Treasury rates breaking the 5% threshold for the first time in over a decade is not just a statistical concern. It landmarks this profound psychological moment, and it has implications influencing both market dynamics and individual decision-making processes. The breaking of this threshold is sowing the seed of a kind of this doubt in both casual and serious investors. Hitting such concerning milestones often leads to speculation about further rate hikes. It also leads to creating an environment of uncertainty and apprehension. Now, for the bond market current landscape is heavily influenced by the U.S. government fiscal decisions, and their escalating borrowing aimed at funding various national initiatives has inundated the bond market with a surge of supply. Balancing this supply necessitates adequate demand. However, the crux of the issue lies in generating this demand, and the market can only attract sufficient demand if the yields are enticingly high, which has led to the prevailing scenario. So given this oversupply of bonds, the bond market is now currently in a state of heightened sensitivity. Now, Silicon Valley Bank and two other regional lenders collapsed in part because of the concerns about the health of their bond investments, and that set off a run of bank closures, or what we call bank run. Now, that said, things could change. Bonds tend to hold well in periods of elevated uncertainty. And right now, there are a lot of worries about the world as Russia's invasion of Ukraine continues and Israel is in a war with Hamas. But okay, what about the Federal Reserve's influence? Now, a fascinating development in recent times is the market's ability to tighten its fiscal conditions all by itself, with minimal direction intervention from the Federal Reserve. Now, this trend of self-regulation suggests a pivotal insight, even if the Federal Reserve halts its current rate hikes, and the rate consumers encounter may continue their upward trajectory. Now, this shift marks a significant return to system normalization, where market forces play more dominant role than the centralized decision. Now, how does this all relate to the housing market? Well, Fannie Mae Home Purchase Sentiment Index offers a revealing glimpse into public perceptions. A mere 16% of consumers currently believe it's an opportune time to invest in the housing market. Now, this historical low sentiment underscores the prevailing apprehension and the lack of confidence in the housing market's current trajectory. The National Association of Realtors, the representative body for kind of the whole real estate professionals, has expressed its apprehensions regarding the ongoing market trends. Their call to the Federal Reserve is clear: a reconsideration of its interest rate policies, and their concerns stem from memories of previous housing market crashes, which resulted in significant exoduses of professionals from the real estate sector. But here's the harsh reality: the current mortgage rate scenario paints a grim picture for housing affordability. To put things in perspective, qualifying for a mortgage on a house of $400,000 now requires an annual income of at least $114,000. This stipulation effectively pushes out homeownership out of pretty much everywhere in the country, making it a privilege largely reserved for those with higher income brackets. And remember that some of the changing sentiment is that those who can even afford a house are not happy with what they're getting for their money. The Federal Reserve's strategy of quantitative tightening, QT as they call it, has been in effect for approximately 18 months. If this strategy persists and the Federal Reserve sustains its current rate policies, we can anticipate further hikes in Treasury and mortgage rates. Current projections indicate that QT might conclude sometime between the end of 2024 and May 2025. The U.S. housing market's current dynamics are shaped by a confluence of factors, including mortgage rate trends, governmental fiscal policies, and market self-regulation mechanisms. For those of you who are possibly looking to buy a home or invest in the home market, staying in tune with these developments and being informed is paramount right now. The market's future trajectory will be shaped by these underplaying forces, and understanding them is going to be key to navigating the challenges and opportunities they present. So make sure if that you're in the housing market or looking to buy a house anytime soon, that you stay tuned by slamming that subscribe button, and obviously guys, hit the like button to show your support. Thanks so much.